Hello and a very warm welcome to Econoday Unplugged on Wednesday, the 24th of May, 2023. Jerry Sheehan's on the US East Coast, and I'm Jeremy Hawkins in London. By and large, the economic data remain all over the place, but one thing that is clear is the marked divergence between the performance of the goods producing sector and its services counterpart. Almost wherever you look, manufacturing is struggling, but in general, service providers are holding up pretty well. And with labour markets so tight, this means that even sluggish growth can support wages and inflation. Adding to the problems for the central banks is that the so-called long and variable lags of monetary policy may now be both longer and indeed more variable. So even if US debt limit debacle can be resolved before time runs out, the outlook for interest rates is far from clear cut. On which note, then, let's move across to Terry. Terry, I was hoping to avoid having to touch on the debt ceiling issue, but since it is still up on the air as we record, what's the latest and how do you think it'll pan out?
We can say on the upside, at least, that Republicans and Democrats are talking, that the House representatives are going to the White House and they are having talks. They both sound very cautiously optimistic about reaching an agreement. So hopefully they are moving closer, slowly but surely. History tells us that every time this happens, where there's one of these debt limit showdowns, they do manage to reach an agreement in the 11th hour. So we're still thinking that the US will avoid the worst consequences of it, but it still unsettles everyone, and it's not a positive thing for either markets or the political climate.
Right. I guess the closer we get to the deadline, the more nervous markets are going to become. On that note, is it the case? I seem that this June the 1st seems to be touted quite widely as being
Yes.
potentially the date anyway when people run out of money. Is that correct?
That is what's out there right now. That's what Treasury Secretary Yellen is talking about. Although, there's no set date yet. They're saying early June, or as soon as June 1st. Some of that's going to depend on whether the quarterly tax receipts start coming in early. If the Treasury actually manages to get through June 15th, that's when there will be a surge in receipts of tax payments, and they could drag it out a bit longer. But that does not seem like that's going to happen.
Okay, fair enough. Okay, then let's go to the economy. Yesterday, we got the May flash PMI survey, which showed, if I remember rightly, composite output index up at a solid 54.5, a 13-month high. But as I was talking about in the intro, the manufacturing sector PMI below the 50 expansion threshold at 48.5, but services up at 55.1. So the first question, do you think that these results are a kind of a fair reflection of what appears to be a lopsided economy? And secondly, if so, does it leave the Fed interest rates even more of a blunt tool than usual?
I would agree with that. From the early surveys of regional manufacturing activity here in the US, it looks like the factory sector remains in essentially recession right now. But services are managing to pick up a little activity. Since so much of the US economy is around services, that probably suggests that we're able to eke out what policymakers refer to as subpar growth.
Okay, on that front, it's very early days yet, but what are the kind of initial estimates that we might see for second quarter GDP growth?
Well, the two Fed Bank GDP nowcasts, one is from the St. Louis Fed, the other is from the Atlanta Fed. St. Louis is looking at a very small negative growth at this point, but Atlanta is looking at growth somewhere above 2.5%. So it's very early days. There's still a lot of data to come out that will fill out any assumptions in these early forecasts. But if you look at an average of the two, growth around 1%, similar to the first quarter.
Right, fair enough. And it's always it's always a bit of fun looking at these now forecasts, I must say, but just goes to show how much of an idea people really have when we're so early in the quarter, just how wide a gap we get between these various estimates. All
Well,
right,
it
let's
depends on what you look at.
yeah, yeah, quite right too. Okay, well, let's go to the Fed then. From what I've seen, if recent comments or official comments running to go by, policymakers aren't too sure about whether the June FOMC should be pausing or adding another 25 basis point to the Fed's fund target or what. So, what's your assessment of where we're going at the moment?
At the moment, I think they are not going to make any changes to rates at the June meetings. Part of that, I think, is because of the current debt ceiling talks. The longer they drag out, the more uncertain it makes things for the economy and financial markets. So
Okay,
they've also,
sorry, can I quickly interject? Let's assume then we
yeah.
do get this thing passed next week.
Right.
What then for the Fed? I mean, how important is this decision going to be?
Well, if there is no agreement, uh, the Fed is going to be looking at a crisis in the U.S.
Hmm.
And as Chair Powell has noted, the Fed can't fix this. This is a fiscal matter. And the Fed, although it can take actions to alleviate the situation, they don't have the power to keep things from going down the tube. So, um, I'm sure Fed policymakers are extremely nervous about this, given the political divisiveness in the U.S. right now.
But if we can put that to one side and say, let's say it is passed, then what about the FOMC then? What's the balance of opinion on it?
Well, it depends on if the current tighter financial conditions are maintained. Uh, if Fed policymakers see that uh, financial conditions are doing some of the work or all of the work of another rate hike, they will probably hold off on any action in June. And I think they actually will anyway. Part of it is that we still got these supervision and regulation issues around some of the regional banks that have not managed their interest rate risk well. And if we look at the weekly Fed balance sheet, we see that there is still lending going on to some banks. So that's a little unsettled. And I think that in part, the Fed would want to make sure that conditions in the banking sector have been fully addressed in terms of the stability. Uh, Although they will, of course, say that the banking system is sound and well able to absorb the current situation.
Okay.
But in any case, I think we're unlikely to see a rate hike at this next meeting. I think we will get some more data on inflation before then. It could make a difference. We've also got an employment report. So if we see further slowing in hiring, again, the policymakers are going to see that past rate hikes are having an effect, and they're going to allow for these long and variable lags to do some more work.
Okay, fair enough. Before I let you go, FOMC, we get the minutes, don't we, later on today? Are
Yes,
they
we
too
do.
old to be of importance, or will you think you can get some gleam out of them as to another clue as to what the Fed might do next?
I think what people are going to be looking for is in the staff forecast, if they're still suggesting that a recession is on table for later this year. Uh, the policymakers' views were not for a recession later this year. So there's some difference there. But I think at this point, we've had sufficient data to suggest that the US economy is still doing okay, not great, but okay. Uh, and it's sufficient in the 3 weeks since the meeting was held that I think any impact is going to be minimal.
Okay, excellent. Anything else you want to put in, Terry?
Uh, nope. We're looking forward to a holiday weekend here, so
Excellent. Have a good one. Let's hope this debt limit gets sorted out. Brilliant. Okay, thanks for that, Terry. So let's shift across to my part of the world in Europe then. Well, Eurozone economy looks to have had, a very poor end to the first quarter. March retail sales fell over 1% on a month, and that's their third decline in the last 4 months. Industrial production was down over 4%. That's its worst performance since April 2020, so just after the COVID arrived. Indeed, Econoday's consensus divergence index now stands at minus 39, and if we strip inflation shocks out of that, it's at minus 55. So, in other words, economic activity in the Eurozone, at least in general anyway, is falling some way behind what markets have been expecting. The flash PMIs we had out yesterday suggested that second quarter growth will be at most very modest. And as Terry was talking earlier on, even then, it's only going to be due to services. In fact, it's quite interesting looking at the gap between the manufacturing PMI for the Eurozone, the headline index there in at 44.6, and services, which was 55.9. That's the widest we've seen since 2009 and the global financial crisis. And indeed, that's very much been reflected in the price pressures, which, of course, the ECB is so concerned about at the moment. In terms of the latest inflation data, we recently had the flash numbers for April. Service sector inflation was up to 5.2%. Now, that's increased every month since January when it was down at 4.4%. So the trend's still very much in the wrong direction there. In non-energy manufacturing, on the other hand, it was down to 6.2%. Clearly still too high, but that compares with 6.6% in the previous months and a peak of 6.8% in February. So as far as the ECB is concerned, then, all the talk is still that the job of getting inflation back down to target is not yet done. And all the signs are that interest rates will be hiked again when we get to the meeting in June. In fact, I guess now for the deposit rate to be left at its current 3.25%, the flash May inflation numbers, the HICP data, and they're due on the 1st of June, so next week, they're going to have to be extremely well behaved. In fact, some of the governing council hawks now are making warning noises to the effect that interest rates may still be rising come September. And the problem is very much that the labour market right across the Eurozone remains very tight, particularly in the services side, which is where the main upside pressure on wages is emanating from. And it's also worth noting that something the ECB pays quite a lot of attention to, which is their own consumer survey. The latest one there found the first increase in households 1 year and 3 year ahead inflation expectations so far in 2023. And that's certainly not going to sit well with the hawks either. So by all intents and purposes, it kind of looks at the moment as if another probably 25 basis point hike in official interest rates from the ECB is nailed on when we get to the 15th of June meeting. As far as the UK is concerned, well, frankly, it's not really that clear that the Bank of England knows what it should be doing at the moment. In fact, the governor, Andrew Bailey, admitted yesterday that its economic models essentially don't work anymore. There's been so many changes to the way economic agents act behaviourally since the advent of COVID and the Russian invasion of Ukraine, that a lot of these models simply aren't worth the paper they're written on. We have had a raft of MPC members testifying on policy over the last day or so. And I guess overall it seems that they're reluctant to hike interest rates again. But really, once looking at today's inflation update, it probably suggests they're not going to have much choice. The economy, real economy anyway, similar to continental Europe, continues to be, or at least reflect services doing all the heavy lifting. Just looking back at the May PMIs, these are flash PMIs again. Overall, we saw the manufacturing index coming in at just 46.9, services at 55.1. So again, it is this service sector which is doing so well. And in terms of the labour market, the other key element that the Bank of England will be looking at when it makes up its mind on interest rates, we had a mixed report last week with gains in both unemployment and employment. But crucially, in many ways, it's the regular earnings that banks looking at. And that accelerated again as up to a 6.7% annual rate. Only a tick higher than last time round, but nonetheless, that's a record high for that series outside of COVID. And so then to this morning's inflation numbers, which quite frankly were pretty horrible. We did see a relatively big fall in headline inflation. That came down to 8.7% from 10.1%. But that was very much biased down by energy base effects following the big hike in energy prices we had in the year ago figures. Indeed, the 8.7% we got was still 0.4 percentage points above the market consensus. More worrying, though, for the bank was the core index. This excludes food, drink, tobacco, and alcohol. That accelerated up to 6.8%. Now, that's 0.6 percentage points higher than we saw in the March data. And indeed, the highest figure we've seen for that since back in March 1992. Now, significantly, the CPI, the inflation rate for goods, that eased from 12.8 to 10.0. But services, as we were talking earlier, which is where the real tightness and the problems are emanating from at the moment, the annual rate there rose from 6.6% to 6.9%. And that's the highest service sector inflation rate we've seen since December 1989. So I think given all that, even if there's a number of central MPC members, I should say, at the Bank of England, who are now starting to think a little bit, as Terry was talking about, perhaps it's time for a pause and see just how much would impact the hikes in interest rates we've already seen in the UK are going to have on economic activity. With core inflation running at such a high level, it's going to be difficult, I think, for at least the doves on the MPC anyway, to prevent the hawks from getting their way. And I expect to see another 25 basis point hike in bank rate next month. Elsewhere in Europe, it's pretty well much the same picture. I'll just quickly point out in Switzerland, we don't get flash PMI data there, but the April PMI showed very much a similar pattern with service sector PMI coming in at 54.2, so a strong reading there, but manufacturing in recession territory at 47.0. And again, the labour market in Switzerland remains extremely tight. In fact, the unemployment rate is just 1.9%. So there's an absence of any real supply of labour, and that's leading to strength in service sector prices, which probably means that the Swiss National Bank will also be raising interest rates again come next month. Elsewhere, just to round off some other bits and pieces, just quickly sticking with some of the PMIs in Japan, manufacturing index there was up to 51.9 for the flash index in May. Services much higher at 56.3. So again, it's this service-led expansion moving forward there, although at least manufacturing growth is in positive territory. The BOJ will also take note, though, of some of the first quarter GDP numbers we had last week. That showed growth rebounding to 0.4% quarter on quarter. Doesn't sound that much, but it was double what was expected. Something that is worth keeping on was the deflator, the overall prices for the economy. The annual rate there moved up to 2.0%. So that's only just short of an 8-year high. So expect speculation about a shift away from yield curve control to rumble on, even though, at least for the time being, the Bank of Japan itself seems to be quite happy with the existing stance of policy. And then to Australia, again, just underlining how unbalanced global growth is at the moment. The May flash PMI there for manufacturing down at 48.0, services 51.8 again. So the similar sort of story about how services really underpinning what growth there is at the moment. And last but not least, by any means, just rounding off the latest central bank announcement. Yesterday evening, the Reserve Bank of New Zealand hiked by 25 basis points to put their official cash rate at 5.5%. That was as expected, but despite sub 50 readings on both the April and the services PMIs, they were 49.1 and 49.8 respectively. Indeed, the overall composite output index was below 50 at 48.5. So, in theory, contracting economic activity, but the RBNZ very much underlining the fact that it's amongst the most hawkish of central banks and raising interest rates. That said, 2 of the 7 members on the voting panel wanted no change. So it may well be that perhaps we're finally in for a pause as far as Reserve Bank's concerned. Okay, then, well, let's round this little off there. What can we say? Well, I guess it's true to say that the lack of balance to global growth can only add uncertainty to the economic outlook. In fact, just last week, I should say, the New Zealand Treasury revised away its expected recession this year. And only yesterday, the IMF upped its UK forecast from minus 0.3% to positive growth of 0.4%. So the economic and financial shocks caused by COVID and the Russian invasion of Ukraine have altered relationships in a way that leave central banks' economic models struggling to cope. and make the timing and the magnitude effects of policy changes all the more difficult to calculate. And while that might make data dependency a sensible approach, it still leaves a sizable risk of monetary under or indeed overkill. Nonetheless, watching the data in general and what's going on in the service sector in particular at the moment is as important as ever. So make sure you keep up to date with all the key market moving statistics and events in Econoday's global economic calendar. With that, on behalf of Terry and me, thanks as ever for listening. And we hope to see you again next time. Bye for now.